Welcome back. I've been speaking with Dr. Raghuram Rajan, former Reserve Bank of India Governor and author of a paper which analyzes how a rapid rise in interest rates can endanger some big institutions like pension funds. Dr. Rajan, thank you very much for waiting on. Your basic scenario, your base scenario is that the Fed is going to go on continuing rate hikes and you're not seeing a cut up until 2024. Now, what about emerging markets? We have already seen some weak wickets fall. I mean, we have seen unfortunate events in Sri Lanka, in Pakistan, in Zambia, in Chad, Ethiopia. You think the islands of some strength and good macros like India, Indonesia, Mexico can be relatively, escape with minor bruises?
Yeah, I think we have to wait and watch and be very cautious over this period. But certainly, countries like India, Brazil have significant reserves, and that will prove, to be a help, if difficulties arise. I think the issue is we're going to be in an high interest rate environment after a long period of low interest rates, when countries have borrowed up considerably, corporations have borrowed up, many have borrowed in dollars. That is not an India problem, but it's a problem elsewhere in the world. And so as the dollar strengthens, as interest rates go up, debt service goes up. And right now what we're seeing is with the enormous withdrawal of funds from emerging market bond funds and so on, the appetite to buy new issues is diminishing. So the big problem for many countries is, debt service, because they have to pay back the old debt, but they have no ability to issue new debt. And even if they had, it would be at much higher interest rates, because interest rate spreads for emerging markets have also zoomed, even as US interest rates have gone up. So it is a tough time. It has always been known that when the when interest rates go up, money goes back to industrial countries, away from the emerging markets. We have prepared for it in India by building reserves, but it doesn't mean that we will be totally immune. Hopefully, we will weather the shock, as you said, with minor hiccups.
Okay. The solace in the market appears to be in countries like ours that we would be the last to be abandoned and probably the first ones to receive when probably the storm subsides.
I think that may well be true, but it's important not to be complacent about it, which is that you have to constantly focus on getting your macroeconomics right, on the central bank having a laser eye towards containing inflation, because the exchange rate, after all, focuses on medium to long-term inflation. And it needs to convince the markets that it is going to contain inflation. That's going to be good for the country. And I think if you focus on that rather than, day-to-day movements in the exchange rate, I think that, in my view, will pay off well for the country.
Okay. Coming back to developed markets, the inflation is high, okay, because the Fed and the BOE and ECB printed a lot of money. But it is also high because of non-monetary reasons. I mean, friendshoring, distrust between countries, war, aging population, resignations, no visas. I mean, visa offices are not even open in Mumbai for tourists and students. So do you think we have to prepare for a secular inflation, even in the West?
I think not yet, because many of the reasons you talk about suggest that growth will be tepid, right? They're constraints on growth. And if growth is tepid, it is below what the potential rate for the economy is, so long as you don't have supply side constraints. So after combating and bringing down the high level of inflation that we have now, the expectation is we go back to the slow growth malaise that we had in between the global financial crisis and the pandemic. That would tend to essentially keep a lid on inflation. The problem right now is we've got a perfect storm of strong demand in the US, combined with supply side constraints. Of course, in Europe, the supply side constraints are higher with the energy prices and the lack of gas. In the US, it's stronger demand, which is the problem. But that's creating a perfect storm. My sense is, eventually the demand abates. People get, have spent through their cash hoards that they built up during the pandemic, and they start worrying about their jobs. They don't, want to spend as much, and inflation abates. But then you start looking at growth, and as you said, many of these factors, the deglobalization. Not yet a big, you don't see it in the data yet, but it will come. And these kinds of factors will take us back to slow growth. So I don't think the inflation, yes, there will be an inflation scare, but I don't think there will be a significant inflation premium embedded, provided the central banks sort of carry out their mandate and are successful in bringing down inflation.
Okay, well, there were some people who were arguing that the fact that you are nearshoring, you did not have the great deflation which the world was able to enjoy because production was outsourced to China. With all those nearshoring, cost of production will go up, and therefore inflation is likely to remain high. And therefore, even governments like India, Reserve Bank of India or central banks like that, need not fuss about 4%, but can be comfortable even if it is below 6%. That is, the 2 to 6% mandate of the MPC. You don't buy that you have to adjust to slightly higher inflation.
I don't think so. I think what you're talking about are one-off adjustments, right?
Okay,
yes,
okay.
supply
Not
chains
secular.
will become costlier, etc. It doesn't necessarily need to be a secular adjustment. And to some extent, what you're talking about is relative prices will have to change because of these kinds of effects. So if in fact your cost of plastics goes up, other prices will come down. It doesn't need to be that everything goes up. That kind of adjustment will happen once you've contained inflation. But if you're sort of merely saying, oh, for all these reasons, we will set a higher inflation target, you will be at that inflation target and in fact have problems in keeping it there and not going further up. So I think you can't be lax about this.
Okay. Well, let me just come to the growth question, since you said a couple of times that we are going to see a return of the slow growth that the world suffered in the decade gone by. That will mean it will be difficult for even countries like India to get to that aspirational 7 to 8% growth?
I think so. I think that even before the pandemic, we were seeing a significant slowdown. I think post-pandemic, given these headwinds, so pre-pandemic, we didn't have these headwinds. Now with all the, reshoring, friendshoring, deglobalization, plus also the fact that industrial countries now have much higher debt levels as countries. And you mentioned aging. That's also starting to hit industrial countries. Which way that goes is a big debate. But put all these together, and I think the accent has to be on clean, clear reforms which enhance the domestic rate of growth without excessive dependence on foreign demand to boost us. Obviously, you want to do as much as possible. You want to be part of global supply chains if you can, but a lot of it has to be, how do we reform our own economy so that we can rely not just on foreign demand but also domestic demand? How do we increase the health of lower middle class households, of small and medium enterprises? That's going to be part of the answer.
Oh yes, sir. Bottom of the pyramid should always be a concern, and perhaps even more now after COVID. Dr. Rajan, just a final question. You leave me with, can we end this conversation with at least the solace that we will not have seizures like Lehman, that we will have dislocations which can be handled with liquidity. Perhaps we have to live with inflation for a longer bit, but this is not a market which will face us with seizures.
Look, all I can say is it's not yet Lehman. Here's the point that Lehman wasn't about raising interest rates. Lehman was, the Fed had raised interest rates, but it had the option of cutting significantly because inflation wasn't as big a concern.
Okay.
I think we're going into this with inflation being a much bigger concern. So the notion that interest rates will remain high for a longer period is out there. Now, it's not going to be a collapse in the major banks as we saw in the global financial crisis, though, of course, we've seen Credit Suisse tottering a little bit. But I think it's going to be more in the shadow financial sector, which we know much less about. It's the pension funds, the ETFs, things like that people will start worrying about. So I would not be complacent and say, no, it's going to be different. I think that is for sure where the knocks come from. I think we have to be very, very careful and keep our eyes open. It could come from anywhere.
Okay, that's a lot of food for thought for the central bankers who have gathered for the IMF fund meeting, IMF World Bank meeting. Thank you very much, Dr. Rajan, for joining us with your insights.
Thank you.
Well, with that, we wrap up on this special edition of Indianomics, very special. More updates and news lined up for you.